For this segment, we're going to be talking about credits and deductions. We started from the very top, the tax return. We'll talk about income, and then now we're looking at all the things that either the government allows you to take, or that as a result of your life circumstances you are able to take to manage your income and thus minimize or optimize your tax bill. Now, credits are items that the government allows you to take because of either decisions you make, situations in your life, and their impact is that they reduce your actual tax bill, right? So with that in mind, since we know that what everybody is trying to do is keep their tax bill manageable, then you need to know the credits that apply to you as an individual. Every Canadian that is born has access to what is known as the basic personal allowance. For 2023-24, it's about $15,000. And even though it's $15,000, that $15,000 is gated, right, by the credit rate of 15%. So the implication is that simply because you are a Canadian, the government says we will allow you to take $15,000 off your 15% of $15,000 off your tax bill. That's just give me money, right there. Now, there are many other things that fit into this bucket, but the one I always like to draw attention to is what I call the super credit, and that is charitable donations. The way charitable donations work, your first $200 is gated at 15%. Then the next gate is 29%, and then the next gate is 33%. There is no other credit that's gated at that level. The implication of it, if we just go by the simple math, is that when you earn $100,000 and your $35,000 thereabout is taken off as taxes, as a result of making charitable donations of $10,000, your tax bill is immediately reduced by as much as $3,000, simply because you find it in the goodness of your heart to make a donation. Whether you make it once or you make it little by little over time through the course of the year is irrelevant. The fact that you made the donation gives you the credit. Now, another credit that is available is when you buy a house. I think for last year, the total amount was $10,000, first-time home buyer's amount. And that first-time home buyer's amount is gated at 15%, which means that you have a $1,500 reduction in your tax bill. Now, this reduction for all of these credits are what is known as the federal non-refundable tax credit. That's a technical terminology. Now, there are a whole bunch of them out there, but all the ones that are applicable to you are the ones that you can claim in your tax return. What I can say is that nothing stops you from finding credits that are beneficial to you and incorporating them in your life for your benefit. So don't forget, credits reduce your tax bill. Now, how about deductions? Now, deductions reduce your taxable income. Not your tax bill, but your taxable income. So, which is the most popular deduction that we see? RRSP contributions. The government says that if you will make a contribution to your future, then we're going to support you. We're going to say every contribution that you make through the registered retirement savings plan, we will treat it like you did not earn that income. So in a typical example, you earned $100,000 and you put $10,000 into your RRSP. As a result of that, the government is going to say, okay, because you put $10,000 towards your future, we are going to act like you didn't earn that $10,000. So your tax bill for the year will be determined based on $9,000, on $90,000. So with that in mind, that's how deductions work. Now, there are all sorts of deductions out there which you can take, but you can only take what is applicable to you and what is a part of your lifestyle. So maybe you have kids that are young, that are in school, and you're paying for supervision for them, or they are in camp, you are paying for supervision for them. Any kind of supervision, basically, or child care that you have to pay for will be considered in this bucket. If you incur medical expenses, it will be considered in this bucket, whether it's medical expenses, particularly that are not covered by any health insurance plan, out-of-pocket medical expenses, to be particular. Now, those are the ones that have a tax, that serve as tax deductions. So on a whole, I think the most important thing I want to draw attention to is, one, you don't have to wait until the end of the year to start looking for the credits that are and deductions that are applicable to your life. You can actually, at the start of the year, say to yourself, what is my situation and what are the credits and deductions that can come into play in my life, and what is the tax implication? For example, if you're a volunteer with the fire service or with a search and rescue team in your city or your municipality, you are allowed a $3,000 tax credit, which allows you to reduce your tax bill by $450. Nothing stops you from finding that credit and signing up to volunteer and meeting the requirement, which is 200 hours over the course of a calendar year, right? And then getting that credit. There's nothing wrong with that. You are actually allowed to plan and say, okay, these are the deductions that I want to take, or these are the credits that I want to take.